Good afternoon. My name is Sean Morgan. I'm the Commercial Director of Fingerprint Supervision, and welcome to the third shift panel discussion here at the Disruptive Studios. Great to have you here. Today's topic is looking at the three strategic directives of the FCA, and we have some fantastic panelists with us today. Claire, Andrew and Sally, who will introduce themselves shortly. So just to remind you, SHIFT is a thought leadership and innovation panel around governance, risk and compliance. Anyone's welcome. If you're interested in joining future panels, then please write in and let us know. You'll find us there on LinkedIn. At the end of the session, we've got an hour of debate and discussion, lots of interesting angles around the strategic plans for the FCA. But all that time, if you have any questions, please send them in, and I can collect them on the iPad here and ask the panelists or to raise it as a topic. So without further ado, if you'd like to introduce yourselves. Claire?
Sure. Hi, I'm Claire Curtis. I'm the CEO of Effective Compliance. We're a compliance consultancy firm in the UK, helping firms get authorised and with their ongoing obligations. We're also looking internationally at setting up in the UAE. And I particularly wanted to come onto this panel because I think it's important for all new and authorised firms to really understand what the regulators are trying to achieve and looking at outcomes rather than purely at the regulation and the details, so that we can actually shift our focus into the good outcomes that the FCA are actually looking to achieve with their strategy.
Thanks very much.
Brilliant. Thanks, Sean. Good afternoon. My name is Andrew Frost. I'm Executive Director at IQEQ here in London. A quick sentence on IQEQ to sort of contextualise our discussion a little bit. IQEQ is an investor services firm, a global firm with around 500 billion of assets in private assets, real assets, and IQEQ regulatory and compliance sits as a section of that here in London. And that's where we're going to talk a little bit about today, the appointed representative model, the regulatory hosting, how that fits into the FCA strategic plan and what they're looking for. And yeah, looking forward to a discussion. Thank you.
Thank you.
Hi, I'm Sally Jackson. I'm a partner at Optima Consulting Partners. We're an international regulatory compliance and consulting firm with offices in London, New York, Hong Kong, and we essentially look after alternative asset managers, predominantly in the hedge fund space and private equity space, looking at a wide range, so kind of from the startup firms, but to quite large established asset managers as well. So we see a lot of interaction that our clients receive from an FCA perspective and an SEC or Hong Kong or US NFA perspective. So I'll try and draw some parallels there and really talk about what we see on a practical day-to-day basis from an FCA supervision point of view.
Excellent. Thank you very much. So Fingerprint Supervision, what we really care about is there's so much regulation going on. The FCA are moving in a direction for more oversight, systems and controls. To do that from a manual basis is incredibly difficult, or it means that people are just in a maintenance mode of running their businesses as opposed to developing them and helping them scale and become more profitable and all those other things that you'd want for a business. So at Fingerprint, what we really care about is taking all those manual steps away from you, automating it and evidencing it, and helping you stick to your policies. So, in the context of what the FCA have produced, their 3-year strategic plan and the three aspects to it, I guess the backstory behind that is the politics, the pressures from Parliament, Brexit, the backstory, London and UK, Edinburgh, elsewhere being, financial capital of the world, all of that. Where are we on all of that? What are the dangers to London, the UK, revenue, tax, the public, all of that? What's important here? What matters most when looking at London's financial services sectors? And what's the end game here? How well supported do you think that is by the government? And where do the FCA fit into that? What's their role? And are they fulfilling that well? Does this 3-year strategic plan fit in with that? That's the obvious starting place to this discussion. And everybody else watching here, I guess they're keen on that because they're the ultimate drivers behind all of this. And what positioning are the government or others looking for financial services? Claire, do you want to?
Yeah, I mean, Brexit, we can't get away from it, right? it's been something that we've all been dealing with, perhaps on a very granular basis in our individual firms. But obviously, away from that, you've got to realise that Brexit could have had a massive detrimental impact on our financial markets. And so obviously there's been positioning to say, well, this now gives us much more flexibility and gives the regulator much more flexibility in making things easier to come to market in your primary markets, in your listings, how they supervise it, especially I think capital markets is a big focus following Brexit. The last thing we wanted was there to be a sudden move from all these institutions in London to suddenly going out into Europe, because guess what? London was now sitting on its own and was no longer had that prestigious place. And I think in one of the documents they were saying that one of their aims was to make sure that that the UK remained at least in the top 5 financial centres of the world. So to do that on a standalone basis without having that access to Europe is a massive push to the regulator. And it is very much, from capital markets, bringing money in, getting people listed, getting international players to still have confidence in our market, and also making sure that that market is clean, so as you have the consumer confidence as well, but realising that now we are standalone, there are going to be differences, good and bad, and then it's going to be access to those European investors, those European companies to come through. That's going to be a really big challenge for the regulator to make sure that capital doesn't get cut off.
Thank you. Andrew, from your perspective?
I think I'll come at it from a sort of structural perspective, and Brexit, when it hit us, made things quite challenging for the investment management sector where we all function in the sense of we're no longer part of a European regulatory regime. Structuring funds and investment vehicles and investment management firms and being licensed in and getting clarity around what that means. I think there was a big kind of shift initially for investment managers to be a little bit worried and be like, okay, we need to take things out of London. We need to set up in Frankfurt. We need to set up an office in Germany. We need to establish our footprint in Luxembourg to continue that European-wide substance and sort of access, I suppose. I think that's shifted as the years have gone on to firms saying, actually, we can facilitate this by continuing to strive and build our London-based UK firm. And I think the regulator's been quite good in sort of supporting that, in bringing out some more clarity. The regulator's sort of lobbying different politics, I suppose, to say we kind of need to get this done because it will detrimentally affect us as a financial centre. So I think if the years have gone past, and even things like the strategic plan they've released, that's all positive to say, stay here in the UK, we can facilitate, we can support you. And for the outside investment as well, we can sit there and promote the fact that, yes, we're a robust regulator, our oversight, our surveillance of the firms that are operating here in our jurisdiction is strong, and that gives the outside capital confidence to say, actually, yeah, London, the UK, continues to be a top 5 financial centre of excellence.
Yeah, I agree with what Andrew's saying in terms of, I would distinguish it between, as you mentioned, the fund structuring and the marketing side versus the trading side, right? So there was a bit of a hoo-ha and there was a bit of like maybe scaremongering, but ultimately the trading side is run by portfolio managers who want to live in London, right? Their kids go to school in London, there's high net worth here in London, their families are here. So from a personal perspective, we didn't see an exodus of portfolio managers. And if anything, they said, well, I'm not moving to Frankfurt. I'm not moving my family to Frankfurt or, like Paris or Dublin or Amsterdam. That's not happening. So we didn't really see an impact on the trading side, and especially, I guess, in that kind of hedge fund space or even private equity space where your fund is maybe Cayman domiciled and all of that stuff. So we really didn't see an impact there. We did see a big impact, and I agree with you, with some of the fund structures where you're actively marketing into Europe, you're getting some of the more wealth management money, kind of pension money, life insurance money, where you have these large international established institutional asset managers that are pooling money into hedge funds and private equity, where it was then a bit like, oh, how do we now access?
How do we do that?
How do you do that, right? How do I get this, German local authority money into my fund now when it's in a Brexit environment. So we did see setups of shifting even, AIFM versus MiFID, where we had AIFMs in London. I've definitely seen a few of my clients where the AIFM has moved, right? So we now have Lux AIFMs, Dublin AIFMs, Paris AIFMs, and MiFID managers in London. So then you kind of go, trading's here. Marketing and distribution is challenging. So we now have these, AIFM structures across Europe that allows us to market. We've seen more activity in terms of private placement agents being used, tied agents being used. So kind of more third-party relationships to kind of access the European markets. And I guess from a competition perspective, it's also, I don't know what the UK government is necessarily doing, but I know, for example, Italy is becoming quite attractive, Milan's becoming quite attractive because they have some very preferential tax treatments in terms of, trying to attract asset management there for firms to set up. So I think there is a competition point in terms of what the FCA is trying to do to say, this is still very attractive, be it for tax, be it because, the MiFID II fixes that they've brought in, where they said now in a Brexit environment, we don't have to fully adhere to MiFID II. They got rid of some of the rules as of this year to basically say, look, we know some of this reporting is really burdensome. No one looks at it. It's not providing consumer protection. It's not beneficial to investors. So they've said to asset managers, don't bother reporting this best execution stuff. It's fine. So I think those little things that the FCA is doing, even on the research rules, they kind of said research unbundling and the fixed income space, it's a nonsense. Everyone knew it was a nonsense. And the FCA has now said that it's fine. You don't need to do it. So I think those things potentially is, FCA trying to make things attractive and competitive against the backdrop of them knowing marketing is a challenge.
So just correct my understanding here, the FCA are there for regulatory oversight, monitoring and supervision of firms, that kind of thing. But they're not there to promote London as a financial capital. They're slightly different things, aren't they?
Yeah.
So where's the directive coming from promoting London or even Edinburgh, the UK as a whole, as a financial hub on a global basis? And where do you see that joined up thinking between, if that even exists in government, depending on your politics, whether that exists, whether you're a Brexiteer or not, do you think there is an even longer strategic plan from a government perspective in making the UK an attractive hub, and then the role of the FCA to fulfill that? Is there joined up thinking?
So I always go back to FCA objectives. So they have 3 objectives as set by Parliament and by the government, right? So one is the consumer protection, the second is integrity of markets, and the third is competition. So they have it written into law, they have to promote competition.
Okay.
And that's where this really comes from, because it kind of they're basically saying if UK markets are not competitive, it's bad outcome for consumers, right? If everyone has to go and shop in M&S or Ocado or whatever, it's not a good outcome, right? So if you don't have Lidl and Aldi as competitors.
So that's referring to competition within the UK as opposed to the UK competing with other countries, is what I'm getting at. So they're looking for fair competition within the UK. Who's looking after the plan for the UK to compete with these others?
Well, I think they are, though. I think,
They are?
that we're looking at the wholesales market review and that sort of thing. And as you say, they've already gone through and they've kind of cut a lot of that low-hanging fruit, that really annoying reporting that nobody ever looked at and we couldn't quite work out the benefit of it anyway. So they've already gone in and said, okay, these are some easy wins. So they've already started to push that. But they're also then starting to look at, where there is to a degree sort of regulatory arbitrage. They're not now having to follow the directives. ESG will probably be one of the first ones where we'll see how closely aligned they're going to be with the European models, or whether they really are going to take this opportunity to make a bit of a shift and actually have it so as it's perhaps we as the UK can be slightly more competitive than potentially our European counterparties. So I think there's that. But the other thing that I thought was really quite interesting from the strategy document was the move of the regulator, the expansion potentially of their powers, and how many times they referred to the Treasury and the Bank of England, and suddenly it felt like it was almost a bit more joined up than it had been.
Okay.
And I wonder whether that's just a tone or whether that really is, you know.
So this is what I'm getting at, almost hoping for.
Yeah, exactly.
Yeah.
They've been forced to do it.
I think we'd all agree that the FCA doesn't particularly have or should have a business development function. Like it's not out there promoting itself and saying, hey, come and do business here and us. But I think by virtue of the policies and the way they change things to make perhaps different areas of London, UK financial services perhaps more attractive than other jurisdictions, I think by virtue of doing that, you're saying, stay here. Like we'll adapt, we'll provide a regulatory framework that may be favourable to what you're doing as a financial services participant.
Okay, so I guess what I'm driving at here, or trying to get to the bottom of in your opinions, is if financial services, well, it is of strategic significance to the people of the UK and tax revenues alone, incomes, you know, paying households, all the rest of it, then the main means to get there would be through financial regulation. What you're saying is making this a credible land where investors feel safe, with the money being within the bounds of the managers here who are regulated by the FCA. So if that's all part of the plan and they're determined to do that, and that's even more important than it was pre-Brexit, then will we see more teeth and will from the FCA in driving these things through? Will they now insist on people following the detail of the CISC handbook, for example?
They're saying that in the paper, you know, and I think they say that every year in the business plan.
But this year, do they mean it? Or?
I mean, who knows? I mean, I think they've been quite good recently in being a bit more active in publishing kind of guidance documents and even like the Market Watch newsletters. I think during COVID, they have been, for me personally, surprisingly proactive in publishing things, you know, setting out their expectations, you know, even things like, you know, who is a key person under what Boris defined, and therefore who is allowed and isn't allowed to put their kids into childcare, which personally I was like, oh, this is very pragmatic and, you know, proactive of the FCA to actually give guidance and say people in compliance and risk are considered to be key persons. You know, even they issued a lot of notices during coronavirus to say their expectations around working from home, you know, and things to do with market abuse, insider trading. The recent market watches, I feel the language has been a bit stronger.
Okay.
So I do think they are doing that, because in some respects, maybe in the last few years, they have been bashed occasionally in the papers as well to say you failed here, you failed there, FCA didn't adequately supervise this, they didn't adequately supervise that. So politically, I think they also do need to show a bit of teeth. And then to your point in terms of, you know, working with the Treasury and the Bank of England, some of the publications have been joined. So it's been joined Bank of England, joined FCA PRA, Bank of England publications. So I think they are, from at least what they're saying, I think, and what you can find now.
So the mood music in the background, the political will seems to be that we can no longer just pay lip service to some bits of the CISC handbook, for example. We will probably more than likely have to do things properly.
I think one of the positives, though, to your point in bringing Brexit into it, I'd be interested to see whether you both agree with me, but like the FCA regulatory framework pre-Brexit was somewhat of a gold standard anyway. Like it was globally what people looked up to, what other jurisdictions went, well, what are they doing? Let's kind of adhere to that, and then we'll know we'll be highly governed and we'll have a robust framework. So I don't think there was much, like there wasn't any further to go in terms of improving it, but I think they've been quite pragmatic to say, okay, what can we do now that we're out of a European regulatory framework that makes it a little bit more common sense for our participants a little bit? And I think people were quite favourable of that.
Yeah, agreed. Because even, so when MiFID II came in and there was transaction reporting, we already had transaction reporting in the UK. So it was a big hoo-ha in Europe, and then the UK were like, we've been transaction reporting for years. FCA's always asked.
It's very true.
So to your point about it being the higher standard, absolutely. So even like the regime between AFMs and MiFID and the top-up permission regime, it doesn't exist in Europe, right? It's like, so FCA has always done a bit of gold plating to say, you know, we hold firms to the higher standard, and this is what we expect.
We see continental managers come to us saying, we want to open an office in London, so we'd better do this properly.
Yeah.
What have you got? It's interesting. So the strategic talk at IQEQ, you invest a lot of money opening products and services around the world and in Europe. How do you see things playing out between London and the continent?
Whew. There still is a global appetite for European capital, right? I think a lot of the investable jurisdictions, a lot of the European sovereigns and the large LPs, they want European structures, right? And now that the UK is out of that, you have to do things like you were commenting earlier, set up your AFM in Europe and remain in a MiFID framework in the UK. That's becoming quite common. I think that will remain. I think if you look elsewhere across Asia, probably not so much Asia, but in the US a lot, you see managers there that have looked at Brexit and have looked at MiFID II and have just thought, no way, it's too, like, I've got no idea what it all means, it's too complicated, we won't bother, are now saying, okay, maybe we do understand this and we need to go over and access some European capital because there's a lot there. So you're seeing US managers come in and look for European type structures. And the framework in Europe and the UK is able to support that. And I think the FCA's taken, rightly so, a bit of a focus on how does the oversight and the monitoring then look for these businesses that are wanting to set up temporarily, set up a sort of a sister company or just an establishment that's not their fully blown business, but a presence in London, because we go back to it is a top 5 financial services jurisdiction.
I think that's also where the authorisations team has been so busy, and I know that we've sort of discussed before about authorisations, and there's in the strategy document there's actually quite a lot of focus on that as a gateway, and seeing themselves as those keepers and looking at the standards that people are actually coming in for. AML purposes, for instance, and they actually said, that we'll actually start looking at AML policies. I thought, oh my goodness, I thought you were supposed to be doing that anyway. So they're going to start looking at that. But they were very much, we're going to be much harder on people coming in to London, because they're looking and saying, look, we've authorised all these firms, and we'll come to obviously appointed reps as well and this sort of thing. And now we're saying, well, okay, let's go in and let's get rid of these problematic firms, whoever they happen to be. Let's get rid of these problematic firms because, and we'll use all of our data that we've been collecting for God knows how long, and we'll look at all these threshold breaches, and we're just going to go in and just close a load of problematic firms. But we're not going to just open our doors. So, we've been saying about, London trying to retain, or the UK, I guess we should say, retain its status and competition, but they're also saying, but that doesn't mean anyone can come in. We're going to actually be upping our oversight, our gatekeeper responsibilities, so we don't just open up the gates to anyone coming through the doors.
Absolutely, great point. And I guess that will lead us on to the appointed rep model, or whether you should get authorised or go to an appointed rep model. But just before we do, just to explore the bigger picture and some of the political pressure, which I guess has led to ARs coming under scrutiny from the FCA as well in their consultancy paper, was it 2134? What pressures do you see the FCA have come under from Westminster in terms of political pressure? There's the Green Seal debacle, politicians' involvement in that. How much of the scrutiny that they've thrown onto ARs is warranted and justified, because there were lots of bucket shop organisations out there not spending the appropriate amounts of money, not having proper systems and controls, and how much of it do you think is just paying lip service to the political pressure? So
again, for me, I think I always look at like institutional versus retail. So I think the AR population that had the retail permissions, which is essentially you have, independent financial advisor, IFAs going out giving investment advice, not quite following procedures around suitability, potentially advising my mum to invest in XYZ is completely unsuitable for her, therefore losing money in the backdrop of kind of coronavirus, general population being pushed into poverty, people not having much money. I think in that context of the retail space, it is very important, and I think the AR stuff in the retail space also links to a lot of the stuff they're talking about in terms of financial promotions, right? So they're really cracking down on financial promotions, even approving financial promotions of
Yeah.
unregulated
Yeah.
firms, which again links to this AR stuff, because that's what they're really worried about, right? So risk-based approach as a regulator, which is correct. So they look at the vulnerability of the population, the less educated element of the population that is looking to invest money and then potentially losing money. And then there's political pressure, right? Because if you then have someone who's saying, I've put all my savings in XYZ because Andrew IFA told me to, and then I lost it all because it was like high risk options, that's not a story that they want to hear. So in that sense, I think it's the right approach. They obviously went across the industry and also then looked at Section 166 institutional principal firms and ARs, which personally, I don't think the risk is there, you know, and I think those Section 166s, I'm not saying they were misplaced. I just think, you know, I don't see the risk there, to be honest. And the retail space, yes, I think that's fair enough. And I think that was worth looking at, but you can probably talk on that.
Yeah, I mean, I'm sure we'll delve into it a little bit more, but I think the political side of things was, in a way, kind of the last straw. And seeing the sort of the front page, a collapse of a large institution that was regulated here in a particular regime was, you know, you've got to remember as well, this was sort of 2-3 years after the initial Dear CEO letter that went out to the regulatory and financial institutions to say, we think we've got to tidy up what's going on here a little bit. So the FCA were kind of on the ball, to your point, looking at retail businesses, and you know, they were very much understanding topics like investor suitability, investor vulnerability, investor appropriateness testings. And regulated firms via the AR model or directly authorised, they just weren't doing it. And I think that's what prompted this quite large-scale, far-reaching review of the industry. And when that was sort of culminating and coming to an end, we had this event with, you know, one of the institutions of the UK failing and making front-page news, and that just brought it all back into the spotlight again. Rightly or wrongly, politically, I'm not going to comment, but that's when you see things on the front page. You see politicians in the House of Commons and on the TV of an evening saying, the FCA need to cramp down, how could they have let this happen? And I think if we're, you know, for those market participants and people in the industry, you're like, wait a sec, like it wasn't the regulatory framework that made this happen.
Yeah.
It wasn't this particular firm as an appointed representative that made this firm fail. Like, I think you'd look at it and go, like, there's nothing really wrong here as to, you know, focusing on UK, FCA, how they were regulated here. And I think there's a, you know, when the politicians start screaming on the front pages, it's a little bit, okay, that maybe there's some education that needs to be done here on how the supervision and oversight and what this model is supposed to be used for, and how it's used correctly.
Yeah. And as you say, it's now become a news article, which then, when you read it coming from a position of knowledge, shall we say, and you read the news articles, the two really don't match up at all. So the man on the street is thinking that there's all these companies kind of running around with an FCA badge on them, and that's basically what's brought down this huge institution, and you know the FCA failed to look at them. You know, but then on the flip side, as you say, we've all probably known for quite a long time that the appointed rep regime has been used and abused by certain people, certain players in the market, and people have, you know, the number of complaints against appointed reps versus, if you like, fully authorised firms is massive, but it's concentrated. But somehow they've now, I think appointed reps was in a very different position to almost any other part of the financial services industry because it was all in one bucket. So whether you were doing retail or wholesale or asset management, it actually didn't matter. You were an appointed rep, you were in one bucket. And the FCA found that massively difficult to deal with because they were trying to legislate for such a wide variant of firm that they couldn't possibly really cover it properly, and yet they can't turn around and say, oh, the appointed rep regime works here, but it doesn't work there, because then actually the bit that it doesn't work in is probably the biggest bit as well. So that has a massive impact on that whole area. And then, of course, they'd have to do something about all these firms that don't have a license. So that's too big a job right now.
The political sort of statements that were made as well, which made the retail consumer that the regulator's there to protect think that this appointed representative regime is allowing these bad firms to come in and set up really quickly and just write off and fail businesses. And we had London Capital Finance and advise your mother incorrectly, and but it's not the case, right? It's, if anything, well, perhaps it was with some firms years and years ago that have now, the regulator has come down and some have de-risked their portfolios completely, or they're no longer in this business. But I think that message was a little bit incorrect to say this regulatory framework that we have in the UK, the appointed representative, it is, when done properly, quite favourable.
Yeah.
The oversight, the monitoring, the systems controls done properly is great. It's just like someone being directly authorised and what the regulator would expect to see from a directly authorised firm. So I think the messaging was just a little construed.
Yeah.
And it creates competition.
Yeah.
Right? So again, to the
Exactly.
third objective of competition, the AR regime creates competition because the burden of being fully regulated in your own right can be quite high. So you might then say, again, and we definitely see it where I have conversations with someone, they say, look, we're looking to set up in London, we're looking at, appointed rep versus fully authorised, and then we have discussions and they go, oh, there's 2 portfolio managers, our AUM is too small, we just do this.
Yep.
And then when you go through it, you're like, being fully authorised is going to cost you, and you need to do all this.
Yep.
And then we do say, look, you're perfect for appointed rep, whatever it may be.
There will be a large part of this discussion, I'm sure, will be the knowledge from the two of you and Andrew as to authorise separately or through the AR regime. But before we do, just stepping back a bit to the economic perspective and looking at the importance of financial services in the UK, the appointed rep model, how important is that to financial services in the UK in attracting? You mentioned it earlier on that lots of Americans are looking for ways into Europe, so therefore who's looking for ways into London? How important strategically is the AR scheme to the economy, to that financial services economy?
It goes back to a point we touched on in our sort of initial opening, what the FCA does. Like the appointed representative model, the concept of regulatory hosting, it's quite unique to the UK. Like you don't see this with the Monetary Authority of Singapore, you don't see it with the Australian Securities and Investment Court. Like it's quite unique to the UK. They have similar sort of incarnations of it in the US with the broker-dealer type arrangement, but over here in the UK, it's, you can come to market much quicker than getting directly authorised. If you're a small firm, you can set up quite cost effectively until your business perhaps gets to a scale that warrants you getting directly authorised, and having fit and proper people directly within your firm to satisfy various functions that the regulator looks for. So I think to that point, the model itself, and by virtue of it being available, makes the UK quite a favourable spot. I think it's quite centred around start-up businesses, emerging businesses. Like you're not seeing a 20-year-old financial services firm set up as an AR. So it's, or you have a 20-year-old US-based financial services firm hiring one person because they're brilliant and they so happen to live in London, and what they're doing is a regulated activity. So in those instances, I think by virtue of having the model available in the UK makes the regulator quite forward-looking. Like it's a good framework for people to come, set up, prosper, grow into what will contribute to the UK economy.
Okay, so that's great to have an understanding of that. We'll examine the AR model versus direct authorisation shortly. So we've covered lots as to the background, the backstory behind all of this, which is what is the will of the FCA to enforce the rules that they've had in place for a long time, even though arguably those standards have been higher than other regions already. But in summary, how would you see that going? You've commented on it briefly, but how do you see things changing, and how would it compare to, will the FCA ever become an SEC in the teeth that they could have?
I don't think so. So SEC is, and we see this a lot, right? So we have a lot of clients that are dual regulated, SEC and FCA, and it's interesting. So it's like they're kind of worried about both regulators in a different way. With the SEC, they're always like, okay, it's been 2 years, they're going to come back. So it's like you kind of know, it's like you're on this like calendar cycle. So everyone's like clock watching.
It's
going,
like
yeah,
defences up.
Yeah, we're gonna get visited. Let's get the paperwork in order. That gets all the documentation in place. And I feel like with the SEC, they kind of know exactly what they need to do. There's like things we have to do. We have to do like quarterly recs on PAD. We have to do e-com surveillance. You know, we have to do like proxy voting stuff, bad actor, and they know. And then FCA, it's always a bit like, what do we need to do? So I think there's a more, because I know we discussed it, it's like everyone's quite compliant because there's this like anxiety of the not knowing, because the FCA never knocks on your door unless you're like a very large established asset manager, or retail banking, obviously. But it's always like, what will make them knock on our door? So we better make sure everything is okay, because you just don't know what's going to make them come in. And when they do come in, how bad is it going to be? Because even with the SEC, you get like a letter, you get some remediation actions, you know. So it's kind of, you know, obviously there is teeth in the FCA that they can also arrest you. But I think from an FCA, the nervousness kind of keeps everyone on their toes a little bit. And I think that works as a deterrent. As a regulatory framework, I think it works fairly effectively. But personally, I would like to see a bit more teeth.
You would?
Yeah, I mean, I guess selfishly, as a consultant, sometimes when I have conversations around, you really should do X, Y, Z on market abuse or blah, 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 you do get a bit of, well...
What are you going to do?
Yeah. What's the worst case?
They looked at this, yeah.
What's the worst case, Sunny? Why are you asking me to spend X hundreds of thousands on this? I'm like, well, you know, it'd be nice. But yeah. So,
but the backdrop behind this is that they are probably going to move in that direction of making sure that people do stick to these rules.
Well, they certainly say they are.
They say they are.
Yeah. And I mean, apparently they're recruiting. You know, I don't know, I couldn't add up all the, as I'm a compliance consultant rather than an accountant, but I couldn't add up all the numbers that they were talking about, extra staff that they would need to get in. But we were talking hundreds of extra staff that they were going to come in. And yet there was also big pressure for relying on data. So immediate actions. So when something was showing up, flagging up on their system, it would be like an automatic close down, you know, and shut them down. And I was thinking, my gosh, so we really are going to be overseen purely on data that gets input into the system, whereas before it was almost the reverse, right? So we were putting data into the system, assuming probably nobody was actually looking at it, but really worried in case they came in and picked up one of our procedures manuals. And almost what they were suggesting now is that they're going to be so data driven that it could actually mean that if they see something that's a red flag, that they'll just stop you doing business, you know, rather than even going in and actually analysing why that's a red flag in the first place.
And they expect you to have that data as well, even if it's unstructured data, telephone calls, communication. We've seen a significant increase in the number of data access requests from the FCA where clients need to get that information to them.
Yeah.
Often they don't know why, but the FCA are very capable in how they're processing this data, and that should be a reason for us to be all on our toes. You're seeing similar things?
Yes, definitely. So I agree with that. So even across some of my clients, I think that market surveillance team, and obviously this links into their second objective around market integrity. So we've seen them being a bit more intrusive on even transaction reporting, which in the asset management sector is pretty poor. And again, it's one of those conversations that we've had repeatedly with some of our asset management clients, and it's the like, well, no one looks at this. Yeah. But actually, we've had a few cases where the FCA is now, because they've hammered the investment banks, right? So Deutsche Bank got a massive fine for transaction reporting. You know, a few of the investment banks did. And now they are actually looking at asset managers and saying, your transaction reporting is all wrong and you need to fix it. Then we're also seeing it through the short selling. You know, we're obviously seeing it through the transaction reporting that the brokers do submit, where some of the asset managers are being contacted and saying, can you do the trade reconstruction and tell us what you were trading on this particular date in this particular listed security and what was it? And it's maybe not to do with the asset manager trading it. It might just be because quite a lot of different firms were trading it on the day. The market price did a certain thing, and the FCA is trying to see what's going on here.
Yeah.
Right, and it's, they've also issued, as I mentioned, the market watchers earlier, they've been hammering and saying they're not receiving enough suspicious transaction reports from the asset management sector. So again, I think maybe a couple of years ago, the feedback from the asset managers was, well, suspicious transaction reports don't make sense to us because we're discretionary portfolio managers. So I don't get Andrew calling me and saying, hey, Sunny, can you execute X? And then I go, oh, Andrew, that's a bit dodgy. I'm going to put in a suspicious transaction report. So they actually created a new field called market observation. So they've said to the asset managers, okay, cool, I understand your discretionary portfolio management, submit a market observation. And so they're now also saying to asset managers, we want to see more market observations, right? So if I'm trading a certain stock today and on Bloomberg I can see the price is doing X, Y, Z, and then I can see some stuff through, some of the MiFID live reporting, and I think, oh, what Claire's doing looks a bit funny.
That's a bit odd.
Yeah, it looks a bit odd. And then supposedly, I'm supposed to go on FCA Connect and go, oh, we've seen this market thing going on. Supposedly, they then go and have a look at it. And then they might knock on Claire's door and go, what are you doing? Don't know, right? That's the theory. So
And it's much more proactive then, isn't it?
Yeah, it's supposed to be.
That sort of thing. And also, from an AML perspective, they brought in quite a lot of information in the strategy document as well about sort of protecting, us from a global perspective on our AML requirements and that sort of thing. And let's face it, I mean, in the press, we haven't actually fared particularly well recently, being quite generous, from our AML controls and how easy it is to set up a company in the UK and that sort of thing. So I think as well that, when we've talked about financial crime, almost in a weird way, we've focused a lot more on market abuse and how clean our markets are, and moved away perhaps from what we've seen previously as being the more basic of the AML and the investors coming through. Whereas, if I look back to, say, other financial districts, they're still looking very much at AML,
Managers.
source of wealth, source of funds. But in the UK, we seem to have actually almost moved past that a little bit and gone, we need to be much more complex and looking at the transactions and fraud and that side of things and keeping our markets clean. But forgetting actually it's really quite easy to set up a company over here. And how good is Companies House? How good are our records? And is anyone really looking back at AML? And now I suppose with everything that's going on in the world, once again, if you're looking at what's the FCA's objectives and political pressure, of course they're going to be getting that political pressure from a sanctions side of things as well. So they're almost having to refocus again back on AML. And you'll start seeing, I'm sure, a lot more the FCA asking questions around your files and how you're keeping those sort of things up to date.
I think you're bang on the AML point, because if I wear my hat as an appointed representative principal, and we know what's expected of us when we're onboarding a new client, sources of wealth of the ultimate beneficial owners, looking at shareholding structures of the corporate entities that's been set up in the UK, and that can get quite complex sometimes. And saying, I know this person owns 30% and they're based in X, Y, and Z, so we're going to do an enhanced level of due diligence on them from an AML and KYC perspective. I think sometimes you go, is the regulator doing this on everyone that goes through to get directly authorised? And I think historically you're like,
right.
I don't think so. Right? But then
now.
they come out and say, oh, this is what we want you to be doing as an intermediary, perhaps principal AR firm. And it's like, okay, maybe take note.
Yeah, exactly.
So we have a question come in from the audience. So just to remind people sat there at their desks or elsewhere, please send in your questions. I'll read them out to the panel, and they will be covered. We have a question here, so yeah, please send them in, and then we will absolutely cover the ground on direct authorization versus the AR model. It's crucial, and how hard it may be to be directly authorised and what's involved, and diversity, inclusion, all these other things that they brought up. So we have a question here from Ranel Pereira. If UK regulation is easier to comply with, passporting may not be possible.
It's gone, isn't it?
It's a problem anyway, I think.
Yeah.
You know, I think the reality is, and just as a little bit of background, I've spent 14 years in the UAE, and in the GCC, they don't have a passporting regime at all. So every time you want to go and see a client, you have to go and see, well, what's going on in that particular jurisdiction. So coming back to the UK, where everybody's like scratching their heads and getting really upset about all of this, I was like, well, actually, you know, this is what kind of happened before. It happens elsewhere. You know, you just need to be aware of what the regulations are and what your restrictions are. And it's great business for the lawyers, and I'm sure that they will, you know, jump on the bandwagon and give you all the advice you need to look at all your different jurisdictions. What it does do, though, is that I think it's made firms really think about what jurisdictions they actually want to go into, rather than just, you know, splattergunning and saying, we want to go into Europe. They're much more focused now, thinking, well, you know, where am I really going to get the business from? And there probably is only some very key jurisdictions that they're actually that worried about. So passporting, it's gone. But whether, you know, us moving away from Europe makes it perhaps slightly more difficult when we then start looking at different jurisdictions. I'm not sure it does. I think it's, you know, whatever our regime here and whatever the regime is, let's say in Italy, you know, that's the regime that we need to be aware of, is, you know, where is the client base, what are our responsibilities there, no matter what we're doing in the UK.
Yeah, I agree. Yeah.
I wouldn't perhaps agree that it's an easier regulatory jurisdiction with the question. It's not easier to operate in financial services here in London versus other jurisdictions. But perhaps for those here in the UK, there are elements where it's favourable versus operating in Luxembourg with the CSSF or in Germany with BaFin. Depending, it's quite specific on what you're doing.
Yeah. Actually, to be fair, an SEC registration is much more straightforward than an FCA application. And this is why we call it an SEC registration and an FCA application, because application is really big. There's lots of stuff you have to put in. SEC, you register.
Yeah, I mean, anecdotally, I had a conversation yesterday with a potential client. They've launched in the US, quite a large launch. They regulated, up and running, trading within close to 3 months.
Yeah.
Right, and they were like, it was surprising, and I was like, wow.
Yeah.
Imagine that.
Yeah, like even Optima as a firm, we do hundreds of SEC registrations, but less than hundreds of FCA applications, because the applications just take us just so much more work.
So on that topic of so much more work, backdrop to this, the 3-year plan, the 3-year strategic plan. Anecdotally, how much harder is it now for a firm to become authorised? And what are they having to do differently than before? How much longer is it taking? What's different? And how painful is it? You guys,
Really painful.
Your firms, and you make a living from advising people on this. And Andrew, you have maybe a different perspective, and your firm spends a fortune helping firms a shorter route, a quicker route to market, but then you carry the cost and the responsibilities. So what's that like for firms applying now?
I think we've sort of had chats about this in the past, haven't we? And it's it is going to be more difficult. I think timeframes are extended. You know, it's interesting reading the strategy document versus what probably we're seeing on the ground. You know, there's been a big push, as I say, to get more people into the regulator. But is it the push to get more people in or to get the right people in? Because, you know, at the end of the day, when an application goes into the regulator, I think what we're all finding is that the responses that are coming back are relatively cookie cutter. And so some of them, you roll your eyes because you go, did they not read the business plan? Did they not read what I just put in for that particular answer?
Clearly not.
Clearly not. It's like, oh gosh. And so then you respond and you find that the case officer's actually gone away for 2 weeks and they just needed to get it off their desk. And so that's very frustrating. And yet on the flip side, they're obviously going to be asking for much more in the things like diversity and inclusion, wind down plans, ICARAs, all of these sort of things they're now starting to ask for. But the problem from my perspective, is that have they got the right staff in to really give a quality review to stop these problematic firms coming in
At the regulator.
at that
At the
point,
regulator,
you
yeah.
know, rather than just going through a process until it gets to someone senior who then actually asks you a question. Oh, that's actually a good question, you know, and I that's something that a firm should answer, rather than, oh my God, please refer to page so and so of the application.
Sunny, you've seen a couple of good questions occasionally. I think I remember you saying.
Yes, we've had it really. I feel like I agree with Claire. It's like you either get a good case officer who's a bit more experienced, understands it, but we've also had case officers where we had to explain the difference between MiFID and AFIRM, and they were asking questions where we're like, no, we're not applying for a MiFID license, we're applying for AFIRM, and this is why, you know, we have these things and we don't have these things. But we've definitely seen way more intrusive questions that we historically haven't seen. So even on kind of business plan, like really challenging revenue models. So kind of, you know, classic model obviously is management fees plus performance fees. We've seen some pushback on performance fees being kind of used to model out the financials, to model out capital and liquidity. We've seen more questions obviously on business continuity plans, you know, that kind of stuff in light of COVID, more intrusive questions on like IT and even like outsourcing and third-party providers, which historically, again, was a bit like you kind of tick the box, you tell them, yes, we're using XYZ firm, it's fine. But I say kind of really asking these questions around what's your oversight of your vendors, you know, who is your IT provider, what is your BCP planning, you know, what's your continuity and kind of succession planning and all of that stuff. Being more intrusive on individuals, talking about AML as well,
Yes.
kind of being quite intrusive on some of the AML stuff, you know, asking around, you know, and then even when you go back and say, look, we're not doing retail business, it's all institutional, all our clients will be regulated, blah, blah, blah. They're still quite like, what's your AML program? You know, so to your point, we had an application where they asked about like enhanced due diligence on like retail investors, and we're like, this
It's irrelevant.
Yeah, exactly.
and we're like, not applying for this, you know.
So it's just a delay, a huge delay to.
Yeah, so I guess to your earlier question about teeth, showing teeth, obviously authorization is a really obvious place for them to show teeth. And maybe some of these questions and some of this process is a way to show teeth, but is it effective? Are you doing it right? I guess, I mean, I wouldn't want to be in charge of the authorization team. I think the training is really difficult.
Sure.
You know, you get lots of different business models. So I think it's a challenge. And hiring hundreds of people into the authorization team, then training them up, then managing the caseload of all the applications, it's not easy, but...
So an application now to run it, to put it in, to run a decent, what the cost is relative to a few years ago. How much? Give us
So it used to
some
be
ideas.
£5,000, now it's 10 grand for any bog standard AFIRM MiFID application. So the application fee has gone up. Obviously the ICARA stuff means that on day one, it's more capital and liquidity costly for the firm as well. So it's just those kind of things.
It's just length of time as well, right? I mean, you have to really manage people's expectations. You know, they say, oh, you know, we've got a big deal that we want to get done in the next 3 months, and you go, and that's where someone like yourself will come in and we're going, oh, well, you know, you might want to think about an alternative, even if it's a step before you actually go to your full authorization. You know, you might want to think about that if you've really got that kind of time pressure that's coming on.
Yeah.
And I think as well, the other thing that I thought was quite interesting, and actually I think is a real positive step, is that, so we're not just bashing the FCA authorisations team, is that they're also looking at a slightly different supervision for people that have just become authorised and those that are also scaling up, which I think is actually a really good initiative, because people that are perhaps haven't been regulated before, who are now being authorised, it is a different environment for them. And I think there are different issues that they have to face. And so having someone that's actually a slightly different focus is probably a good thing for making sure that if there are issues, that they're caught at that stage rather than leaving them until they come and visit them in 10 years' time.
Bad habits or
Yeah.
culturally building something that you're like, what's going on here?
Yeah.
So what's the FCA's angle when it comes to the application process and diversity and inclusion? What obstacles are in the way there? What are they looking for? What's changed? What do they want to see done differently, and why?
Yeah, I mean, there's a lot of lip service probably around it. I mean, they're looking, I think we'll probably see more coming out, once we've got final rules and that sort of thing. I mean, at the moment, when you look at the FCA's speeches on it, a lot of it's actually focused on their own internal diversity and inclusions. And I guess they're kind of laying the grounds for their expectations. And so I think we'll see more of that coming through. But right now, I think you're right. It's much more, if you like, scaling it back to your financials. Are they realistic revenues? Are they realistic budgets? Where are your risks? And more on that than they necessarily are saying, can you show me your diversity and inclusion policy? And if you do, that's probably as far as they will go right at that beginning stage.
Yeah, and then even on diversity, obviously FCA is a risk-based regulator and the rules are proportionate. So even in the CISC rules, you only have to have a diversity policy or like a nominations committee and all of that if you are one of the larger firms. So, even under the kind of new IFPR stuff, it's the kind of the non-SNI, enhanced non-NSI classification that puts you into this bucket of like, nominations committee and diversity and remuneration committee and all of that stuff. So, So because I think there must be an element of saying if you're launching with like 5 people, meeting diversity can be challenging, right? So,
So the rising costs of authorization, the opportunity cost of it taking a long time and launching your business or investors coming in, but then to the backdrop of ARs are under pressure from the regulator to put better systems controls in place. I know your firm spent a small fortune putting systems and controls in place.
Yeah.
Becoming, a market leader in what you do in the AR space. What opportunity do you see this as an opportunity for the AR model and the economy, or how does it all fit together from your perspective?
Yeah, a few things to touch on. I just want to anecdotally share something. I knew the FCA was in a little bit of a pickle in terms of its timing for authorizations when one of my compliance managers rang me. I think it was the back end of 2020, beginning of 21, and he said to me, just want to let you know, and when you submit an appointed rep, you'll get some case officer questions. And he just said it was just something that normally they say, please turn these around within 48 hours. And this one has come back and said, please provide this within the next 4 weeks. And it was like, what? And it was like them putting up the flag saying, all of this stuff's going to start taking a lot longer because we're underwater, perhaps, whatever the reasons may be. But it was a bit like, oh, geez, that's changed. Take your time. Take your time. No, we'll answer that today. No, it's okay.
Yeah.
What was the other thing I was going to say in our discussion? I think also, subjectively, the hosted route is beneficial and advantageous to go through and get directly authorised. Because a lot of these things that the ladies have been discussing of, the FCA receiving a direct authorisation application from nowhere. It's just come out of the blue. There it is. These are the people behind it. That's one thing. Versus, Effector or Opta might do an application for one of our clients that have been up and running and operating their business for the last 6, 9, 12 months. So submitting an application, they might say, we'd like to see your compliance framework, your compliance monitoring program, your gifts and benefits register. It's like, here it all is. We're doing that now, albeit in the confines of a principal AR construct. So, I think applications that come through from an AR to sort of mature into a direct authorization, subjectively, I'd like to think it goes into a little bit of an easier pile, perhaps, of, these people have shown that they can drive the car and maybe progress from their learners to the Ps to a direct license a little bit easier.
Yeah, agreed. And also even from a consulting perspective, it's easier to speak to the people that have been ARs because sometimes you speak to someone who's, looking to launch and the regulatory language is a bit like, okay, let me explain this to you and what you need to do. And
exactly.
So you're educating your client as well as, and we do have some maybe slightly tenser regulations where situations where the client is a bit like, well, why do I need to do this? I don't want to do this, and you then have to explain it. Whereas if you come out of an AR model, I don't have to do that education because they've been operating in it. They're used to it.
Because a lot of the clients that set up in an AR framework as well, they've been at Goldman Sachs for 15 years, or they've been at Barclays or Mangrit. They don't actually have any idea about how the compliance and regulation of those firms work. Right? They come in, they scan in, they sit in front of their trading desk and off they go.
Yeah.
But then they go, well, now's the time, I'm entrepreneurial, I'm going to set up my own business. And it's like, this is all on you now.
Yeah.
And I think I agree with you. It
Yeah.
must be easier when they're like, yeah, I understand this now. I've had to do this on a
Yeah.
monthly basis in my business,
Yeah.
where I've kind of never really had to
No.
do that or understand it. Or
Right, yeah, because you're right, because it's like Goldman Sachs market abuse monitoring happens in the background,
Yeah.
record keeping happens in the background, phone recording happens in the background,
Yeah.
e-com surveillance happens in the background. So Mr. PM out of Goldman Sachs goes, I want to set up, and I go, market abuse surveillance, e-com recording, telephone recording, blah, blah, and they go, what? Like, you want me to spend money on
Can you
all
do
this?
that?
we have ones like, you went to Wimbledon. Yeah, so-and-so took me along. You're like,
Yeah.
you need to tell people about that. It needs to be approved in line with your gifts and inducements policy. And they're like, what?
What
Yeah.
is an inducement
Yeah.
policy?
Welcome to the world, right?
Why can't I do this deal on WhatsApp?
Yeah.
You can't do this deal on WhatsApp.
Yeah.
You can if it's recorded.
Oh, right. Right.
I think as well, the other thing I've seen pushback much more on is that sort of ready and willing type of assessment as well. So for individuals, like the interviews that people are going through now, especially if they're taking on the compliance or the MLRO role and that sort of thing, their expectations are a lot higher, and they're almost to the point where they expect you to be able to demonstrate certain things as if you're already up and running.
Yeah.
And that's quite difficult to do when you're in that sort of, I'm just about to set up a business mode. So, having had a bit of history, there is something you can demonstrate, whereas without that, it's actually quite difficult for firms to kind of wrap their head around, well, I can show you a policy, but I can't show you how it lives.
How it implements into my activities on a day-to-day.
Yeah, definitely. I think also the market in terms of talking about people, like I've had a few conversations with potential launchers and I've said, look, you need a money laundering reporting officer, you need a compliance officer. I think the market's quite tight at the moment to find these people, right? So it's like you can find traders, portfolio managers, maybe even like COOs, CFOs, but to find someone to wear the hat of the SMF 16, SMF 17 is challenging. So then again, the platform comes into play, right? Because you might say, okay, I can do everything else, but I really can't find someone to wear that hat. And the FCA is not going to tolerate your CEO or your CIO wearing those hats because you've got segregation of duties.
I completely agree with that. And I think from a consulting perspective in your businesses, like the wave and the snowball of regulation over the past 5 to 10 years has been enormous. And I'm sure you've gone into businesses and you're like, okay, so this whole MiFID II thing, it's going to happen. Like, where's your compliance officer? And they're like, oh, it's me. And you're like, but you're the CEO. And you're like, you're the CIO as well. And they're like, yeah. And you're like, oh boy, okay. Like, you're going to have to give that up and hire someone that's fit and proper to be dealing with this stuff now.
Yeah.
And they're like, oh, okay.
Yeah.
That's going to cost money.
Or,
It's like,
oh no, I'm not doing that.
yeah.
It's interesting from our perspective seeing people struggle with new processes, obligations under regulation to do X, Y, and Z, record this, monitor that, and their default for these things is to put a manual process or a check in place or a tick box. But maybe people's first thought isn't necessarily to reach out to technology, or that's something investment banks do or brokers do. It's not something that hedge fund managers do where they work with a tick list. Or so, for example, random sampling of e-coms was something done 20 years ago when I was just out of university and working in the operations of a hedge fund, going in and listening to the random calls. People still do that 20 years later.
Yeah.
So we're talking about the burden of regulation, systems, controls, but I just wonder, do people understand quite what technology is capable of, and why aren't they adopting it to meet their regulatory needs? You you can design policy in a system like Fingerprint and then evidence that you're sticking to it. There are other people out there that do things similar. So this stuff doesn't need to be that complicated, checklists but the whole, often the compliance consultancy, that kind of repeating what the advice we used to give people 15 years ago. Do you, it's word
also think
checklists, it's just...
There's a bit of a mental shift as well. There's a lot of people say, "Oh, I'm too small."
Yeah.
That's always like, I'm too small to have technology in place. You're like, no, you're small, so you need technology in place. Otherwise, you need people. So then you will end up being bigger and also having technology in place. So I think that's where a lot of people come from. As you say, if they come out like the Goldman Sachs, they are expecting, because Goldman Sachs has got those, we're using those as an example, but obviously they've got like huge IT budgets and infrastructure, and they're going, actually, I don't need that. Because I'm just a small business, so I'm not making a massive impact on the market. I don't need that overhead, I don't need that cost. Rather than thinking of it in almost polar opposites, which is actually, as a small business, you can reduce that kind of cost by having technology in place, and actually now it's completely scalable. So you don't have to be 100 people to want to put in place a technology system to monitor communications, to monitor for market abuse. That's not the case anymore.
It baffles us as to why people would want to invest in and spend more money on maintenance activities through humans, when all they want to do is get on and run their portfolios or grow their business or scale profitably. Why? They're not, I mean this politely, they're great managers of money, but they're not necessarily business people who think in terms of efficiency or operational efficiency, which is exactly what you need when it comes to regulation. Great at running portfolios, even COOs and heads of compliance, they know what the regulation is, but the default is to check it manually or do it manually because that's where they've come from. And so much of this burden that the regulator puts in place can be met through technology, and it's a shame that people don't understand that more. Investment banks do.
One pleasing thing to see in my perspective of this 3-year strategy plan is their focus on technology and data and talking about things like AI, because having listened to them within the confines of IQ-EQ over the past few years, and in listening that they want technology, they want digitalisation, and we spend a lot of money on doing that in our business. We're a long way down due diligence at selecting vendors like yourself, Sean, to conduct these forms of what is expected in the eyes of the regulator. And you implement that with clients, but then you also looking, I'm sure you see it in the consultancy world, you're like, how are you guys actually doing this? There's like filing cabinets, there's like papers.
But yeah, awful. And I even use GDPR. So if someone goes, oh, here's my fit and proper assessment, look, he's put a wet signature on it. It's like, this is just GDPR risk. I've now got a wet signature piece of paper. That is my annual SMCR certificate. Okay, I know you've only got 20 people, but now I've got 20 pieces of paper with 20 signatures and names and, FCA registration number and maybe national insurance number. Well, just why? But I think it's, to your point, they don't see the value in the money. So it's kind of, okay, so how much is it going to cost me? And then they go, okay, but then I've got this person that's kind of doing ops and kind of doing trade settlement and kind of doing IT and kind of doing HR. So he's also doing compliance. And I pay one salary. So you're now telling me, oh, I got to go and invest in the system when I've got that person over there doing IT, ops, HR, and compliance. All good. That's the challenge.
I think as well, there's a place for everything, and if they look at sort of, there's a lot of our work as compliance people that can be quite administrative. As you say, I remember myself, going through, I was at the London Stock Exchange, going through listening to voice recordings and things like that. I mean, pointless. Most of the time I was just hearing about what they were going to have for dinner that night and that sort of thing. So, you can actually eliminate that and focus on the real risk, the real problem. So when you get the alerts, it's already sifted through God knows how many, let's say, phone calls or emails or WhatsApps, to give you the breakdown of what it is you need to be focusing on, rather than just these random samples, which are unfortunately very tick the box. And I think there's a lot of sort of monitoring work that actually your AI tools and that sort of thing are much better at doing, so as you can focus on issues.
Random sampling, I mean, it's just the most futile thing to be doing in this day and age. benefits nobody. Yeah.
Well, one thing, Sean, we focus on a lot in our discussion today is doing what the regulator wants, right? And I think what's shifted in the last few years is, yes, of course you need to comply and do what the regulator wants. But also, if you're going to go out to the market and raise money, there's a lot of pressure now coming inward from your investors to say, I want to see this. I want to see your robust governance structure around trading, around e-coms, around what's your surveillance model, how are your teams, what's your attestation frequency and how is that done and recorded, and all of these things. So we, as a provider that sits in that sort of intermediary role, we get that a lot from consultants that say, oh, okay, Sean, we're going to invest 100 million in your new business. What's this IQ-EQ bit? How does that fit? And they understand the concept and they're like, well, we need to pop the bonnet there. And I see the questions that come through from operational due diligence visits and things, and you're like, wow, you're asking these questions like a regulator, you're coming in like an enforcement, you're coming in like a inspection investigation, and that's what's driving a lot of this, I think, positive change. A lot of this adoption of technology is, yes, I'm sure they'd like to say it's to satisfy what the regulatory requirements are, but it's probably more to satisfy the investment that they're getting into their funds, into their strategies.
Agreed. It's a commercial decision because it becomes like we have to do it. We don't have a choice because otherwise we're not going to get that pension.
It's
money.
not like if we don't do it, we'll get in trouble. I can satisfy that. If we don't do it, your business will fold.
Yeah, and we're seeing that a little bit with this SFDR thing. So just to stray a bit away from it, even though Brexit and SFDR, so it was kind of like, oh, cool, we don't really have to do SFDR unless we're registered for marketing in Europe. But we've seen the shift this quarter where investors are saying, not investing unless you're Article 8. And it's like, okay. So again, it's not the regulation. It's the investors saying, you want our money, you better be Article 8.
And also, it also matches what was coming out, which is the sort of trying very much to say we're an outcomes type of regulator rather than a process type of regulator. And, when we talk about, compliance in the traditional sense, we have been that process type of department. This is how you check for things rather than necessarily seeing sort of what's the outcome, what's the good outcome that we want to make sure has achieved. And I think that's going to take a long time for firms as well as the regulator to really wrap their head around, because with the best will in the world, when the regulator comes out, they have a checklist of a variety, and a lot of that is very difficult to be able to demonstrate the outcome as easy as it is to demonstrate a process. And so I think that's going to take, as an internal compliance officer, that is something that I think firms need to sort of try and think about a lot more, is how they demonstrate an outcome and then look at the process to get there, rather than let's just look at the process because that fits what the regulators want. And even, from an investor perspective, then I can show them this. Because actually the investors want that because they want a good outcome.
Yeah, agreed.
Well said.
So looking back, within the strategic plan, the adoption of tech at the FCA itself and their thirst for more data and information, we understand that in the term of structured data. I briefly touched about e-coms. How are they using that data themselves, and how will they follow up, do you think? So we briefly touched on it earlier on, but to what end, and how will they use the data? So they're building information themselves as to how people are trading and...
Yeah, I think they're going to use it for red flags, patterns, and once again, even with recruiting, God knows how many extra staff, they've also having to be able to concentrate on the key risks, and that's where they come up with the idea of the harm concept. Where actually is the harm going to be done? Because that's where we need to focus our energies and efforts. So the data really is going to be driving where they can see potential harm. And as I said, some of it they're using for almost automatic switch cutoffs, because rather than having to put a lot of effort, energy, time and resources into something where there's already red flags all over it, they realise that there is a legal risk in doing that as well, by just purely looking at data and just pulling a plug without actually asking the questions and doing due diligence as to why that red flag's coming up, opens them up to potential legal questions as to whether, you know, they were able to do that. But they say, do you know what? The reality is 9 times out of 10, it was the right decision. So on that, the risk-based regulator has now got his hat on, saying we're using data to help us turn the plug off to things where we think that the harm could happen quite quickly. And, you know, I think unfortunately cryptos have kind of come under a bit of a bashing in here, you know, because everything they talk about from risk, there's a little phrase somewhere that says something about crypto. And so, but they point to something like that where they say harm can be done so quickly that if we're not real time and we're not actually focusing on the data and getting these red flags, then actually there's significant harm that can be done to life-changing harm, I think is what they use for underlying investors. So we just want to be able to pull the plug.
Where does the responsibility sit between, is that the regulator or someone sitting within the risk management function of the actual investment manager should be like, you know, what's going on here? Get out of those positions, or why are you trading off that avenue? It's kind of like, you think that expectation should be, you should be doing this in your own shop rather than us kind of overseeing you and saying, well, wait, come back here. Stop doing that incredibly.
Yeah. And I think that's the thing, isn't it? I think well-run firms will be stopping it before it gets to the regulator. And I think that's almost what they're saying, is that, you know, if
it gets to us,
if it gets to us and you haven't even picked up on it, then guess what, people? You've just given me this information.
Yep.
So you're almost self-certifying and confessing, you know, we're not doing things right. And they were talking very much about threshold conditions, which I think is quite interesting as well as to how they're going to do that. But as with most sort of business plans and strategies, the wording is relatively high level as well to know exactly.
So give
how
us an
to use it.
example, threshold conditions.
Well, this is the thing, they don't give you an example. And so they talk about threshold conditions and alerts, and I was thinking, well, the only things I could think of that would be automatic would obviously be on your financials and your prudentials. That one's quite an easy one. But other ones, what are the other things that are going to trigger that kind of an alert in a system where they go in and they just say, right, that's it, you breach your threshold conditions, and they cut you down. And they don't go into that detail anywhere. But they do, which is also quite interesting, set out all these metrics that we haven't sort of touched on yet as to how they're going to actually monitor how well they're complying with these business plans and strategies and that sort of thing. And I think that's probably more interesting for firms on a practical level to say, well, how is it that a regulator is looking at what the metrics are as to how they're achieving this, to know where their focus is also going to be, but they don't really give you that kind of detail.
Yeah.
But so it's interesting about their own metrics, because we saw this a couple of years ago with authorizations, where they had internal service level standards of having to authorize firms within 6 months. And then as they couldn't cope with the volume, I mean, this is me speculating as my own personal view, they would then go, we strongly recommend you withdraw your application. Because if you withdraw your application, then I haven't missed my deadline. Right, so you might see some political play around, you know, some of their own metrics. You know, maybe more enforcement cases to meet the metrics on that side as well, to kind of make an example of certain firms. Maybe we might see them coming fairly harsh down on certain firms just to say, no, we are doing this and we are doing that. You know, so I don't know in terms of what their own metrics are. Obviously, that could be a bit of a political...
I think to your point as well, discussing this with a compliance colleague at work last week in terms of the strategy paper and the business plan, and the term that was raised was interpretation. And it's kind of, you look at some of the things that the regulator comes out, and it's like they're purposely saying, oh no, we're not going to tell you. No. We just want you to interpret this the way that... And you're like, is that helpful? Like, or is it like... Okay, interesting. And it's a little bit like your point earlier. It's like we're just constantly a little bit worried that they might come in because we don't know that every 2 years we should expect a visit. And come on, guys, polish your shoes. The SEC is on its way in. It's about that time. It's like we're just constantly interpreting that we have to be complying with. It's like, well, it's
like they don't say to you, you must have electronic, you know, market abuse surveillance. They say you need to have market abuse surveillance that is proportionate and appropriate for the nature, size and complexity of your business and the asset classes that you trade and the way that you're trading. Cool. So, like, how many trades per day doesn't mean I need to have electronic. What asset class it means I need to have electronic. They don't tell you, right?
Yep.
SEC says you have to record all your emails and compliance has to test it. You have to do quarterly PAD regs. And it's like, cool, thanks, I know. So I'm now doing it. It's process, not as outcomes focused, but at least they tell you. FCA outcomes focused, I much prefer, but it does leave a lot of
Grey areas.
loads.
Interpretation.
Yeah.
So I'm just looking at some more questions coming in here. Some of them take us back a little bit. I could have asked the questions earlier, but you were on a theme in your discussion there. There's one here from Sarah M. With the FCA under so much pressure, what risk does this longer-term plan present to the wider industry to stay competitive? How will it be achieved with realism?
Well, I mean, they're going on strike, first of all. I mean, I've never heard of a regulator going on strike before. I don't even know what that really means. I think, once again, it's the same, the strategy, the business plan, you read it and it all makes perfect sense. You also think, well, that's probably what they should be doing anyway. I was talking to a colleague and I was probably showing my age, and I said to her, you remember the film, Jerry Maguire? Where he goes around with the mission statements and puts it in everyone's pigeonhole. It feels a little bit like that. There's a lot of very positive noise in it, but the fundamentals as to how to remain competitive, when the reality is that we're all finding timeframes are being delayed. Questions are not perhaps at the quality that we want to see them at. The oversight still isn't quite there. They've got people actually in the regulator who are fed up enough to actually want to go on strike. In that backdrop, this strategy paper is fascinating, but how are they going to actually achieve it? And I think it's going to be a real turnaround story if they can do it.
Yeah, very good. Any other thoughts on that, or shall I ask the next question? So the next question is from Tom B. There's been a lot of discussion around the alternative space and new and growing firms. What does this plan mean for more established firms and those that are retail facing?
I mean, I personally think, retail, again, risk-based regulated, there's always lots of focus on retail. I think especially coming out of coronavirus, I know they've really focused on credit. So even in the alternative space, we've seen a massive blow up in credit because there's a lot of distressed debt in the market. Mm-hmm. So there's a lot of credit being picked up. So I think from a government perspective and an FCA perspective, you're obviously politically concerned about poverty, credit, debt, mortgage, loans. So I think from a retail perspective, they will focus that in the paper. They talk a lot about consumer outcomes, consumer protection. Obviously, we're not really focusing on retail, but I do think in that regard, I expect to see them use some of the product intervention powers. So, I do expect them to come in and do product intervention, pull retail products off the market. They don't want another interest rate swap mis-selling crisis or any of that kind of stuff. So, I think for the more established asset managers, I think I would really look at product governance. I would really look at that because MiFID II rules have been around on product governance. Everyone's kind of done it a bit-ish. But, the FCA has done transitional provisions on PRIPS, UCITS. So they are really focused on the retail space. I know it's not really our area, but if I was an established wealth manager with UCITS, PRIPS, any of that stuff, you're subject to product intervention by the FCA at any given point in time.
Retail wasn't our area of expertise either until about a year ago, and then there was a huge uptake from retail and wealth managers of monitoring and supervision. What advice is being given to the granny down the street? And also communication tools where IFAs and others wanted to use WhatsApp to sell products. Right. And before that was off the table because you couldn't record it, couldn't monitor and supervise it. But I think retail may have their game together around a number of things. Yeah. But the scrutiny from the FCA. But the retail is very much around focused about the population in the UK already. And then we've discussed money coming into the UK and remaining competitive on a global scale.
I quite like their initiatives on financial promotions.
Right, exactly.
I actually quite liked that because I do think that there is a lot of information out there. And we saw the move with Google. I think that was a great initiative. And I think actually having people that have that permission on their license, so they actually understand what a financial promotion actually is, which is kind of helpful in itself. And that they're actually qualified and they're expert enough to be able to approve such a promotion, I think is a really good move. And I think they have actually done quite a good job on the sort of scam smart and the watch lists and that sort of thing, and all those firms that are out there, which are effectively the ones that perhaps they are the problematic firms, but a lot of them are unauthorised. So they're not actually in the FCA space, but the FCA are cracking down on these kind of scams, and I think that's a really important job that they have actually taken, and they've tried to move forward pretty well.
I love your point on financial promotions. I think it's one of the hazards of the job working in this industry, and I'm sure you'll agree, where you sit on the tube and you read something and you go, oh my God, like how on earth
I'm going to put my money in.
are they saying that? And
It's not
with
guaranteed.
knowing what we know,
Yeah.
and you think, gee whiz,
Yeah.
wow.
But I do expect actually on financial you saw what they did with John Lewis, right? And the John Lewis advert. They pulled it, because they said, oh, the boy smashing up the house, it kind of implied that your insurance cover would cover intentional damage, which it wasn't. It's an accidental damage cover. So,
I didn't know that.
Yeah.
So I completely missed that.
Yeah, FCA pulled the John Lewis advert.
Wow.
I mean, there was social media...
Misleading, misrepresentation, all of these types of things.
Wow.
Yeah, so I do expect them for more established managers, like I said, in the packaged retail investment product space, I would expect them to use those powers to protect consumers.
So we literally only have a few minutes left, and I was looking for a summary as to what are the key points, what are the messages you want people to go away with, what would you encourage them to do differently or think about differently. There's a couple more questions here we could just go through very quickly. So from Mo Rahman, will the FCA's strategic plan do more harm than good in terms of remaining as a competitive destination for alternatives? The next question from Abdul is, does the panel feel that the FCA are fit for purpose and can cover a full range of businesses and business types do they feel as though they're capable
I'll jump in and say yes and yes. I think to Mo's question, this strategy statement, it's pro-business.
Yeah,
it's like we're here to help. We're showing that we're doing a good job. It's continuing what we touched on earlier as we're a best of breed regulator. We don't have that many problems. We've got problems, everyone does, but we're a good place to come and do business. And this is their way of sort of publicising it. But as we say, it reads well. Let's see it implemented over the coming years.
Yeah, I think for alternatives it's a good space. It always has been. I think London is a good space for alternatives, definitely.
So what will 2025 look like when the 3 years pass?
Oh, I think we'll be full of robots and flying cars, right? No, but equally, I actually do think that data, fintech, regtech, whatever you want to call it, I think you can't ignore it. You shouldn't ignore it. To really achieve these sort of outcomes that they're talking about, is all going to be based on data. The market's too big for them to have that kind of personal intervention. They're going to have dashboards and red flags and all these great words that we use in our day-to-day roles, but they're going to have them, but so a firm's going to have them as well.
Closing thoughts from you both?
Fortunately, I think we're all in the right place. Come 2025, professional service providers in compliance and regulation will be successful because it's a space where the people and the institutions that the regulator's regulating, they'll need to use us, right? They're not going to be building this out internally with their firms. They'll need technology systems that they don't have. They'll need the regulatory and compliance know-how and technical expertise. They'll need solutions that satisfy various situations because the regulation and compliance snowball, it's not going to get less. And it's not like we're not going to become an easier place to do business in terms of regulation.
I agree.
I think it's good news.
And from you?
For me, it's always about risk-based approach, to be honest. I think whatever business you're in, whether you have retail or not, whether you're alternatives or PE, really look at your business and think about the risks within your business, what rules apply, how do they apply, and then build your program around it. I don't think this tick boxing process approach works. I think and see it as a commercial opportunity in terms of investors, you know, in terms of the story that you want to tell in the capital raising process as to what is appropriate for your business and build your infrastructure around it across compliance, risk and everything. Like risk-based approach, and it's a risk-based regulator, and investors are very risk-focused. So I just think that's the overriding message I would have.
Great.
Don't look at rules and tick, basically.
So a huge thank you to our panel, Claire, Andrew and Sally. Thank you very much. Great debate. Learned loads myself as well. Thank you very much for joining remotely and listening to the discussion. And we'll see you on the next shift panel. Thank you very much.